Hi, I'm Dan Westfall. My company is Client Focused Financial. So today I'm going to talk to you about the different ways that a financial advisor gets paid. So I was meeting with a lady last week and she asked me the typical question that I get, Dan, how do you get paid off of my account? So I explained to her that the way that I get paid is on a flat percentage basis off of the money that she were to invest. So in the example I gave her, if she invests $100,000 with me and I were to charge her 1%, that I would make $1,000 a year off of her account. Now, my goal though would be to grow her account, because if she had an account that's $120,000, that 1% would be $1,200 in revenue that my firm would get paid off of that. If her account went down on the other end to say $80,000, that 1% is only $800 that I'd be making off of her account. So then she explained to me, she's like, all right, I get that. My current advisor, the way that he charges me is every time he calls, he makes a transaction on my account, and I pay $250, $400, $500 per transaction. And I explained to her, I'm like, well, that's just because he works on a commission-only basis where he's charging you per transaction. So we're two different types of advisors in that way. And that leads me to the two main types of the ways that financial advisors get paid. On one end, there's your commission-only advisor, where they're charging you for transactions, for financial products that they're selling you. Those are things like mutual funds or annuities, or they're charging you for trades that they're making within your account. So, typically on a mutual fund or an annuity, those are those financial products. They may charge, or they may make 3 to 5% on a mutual fund, or 5 to 8% on an annuity. On an annuity, they can actually take less up front and get paid more of a residual, but I'll talk about more of why they probably don't do that in a lot of cases, and it's really because they don't do customer service with their clients. So on the other end of things, there's a fee-only advisor, and that's the way that I work and my firm works, where we charge anywhere from 1 to 2%. That's the way that all fee-only advisors work, is it's on a annual percentage basis, where just like that example I gave you, our goal really is, number one, customer service, because we want to keep clients. Because if I'm getting paid on a residual basis on it, I don't get just paid this one-time upfront thing. I get paid every single year. So ideally, there's two things I want to do with all of my clients: is A, keep them as a client, and B, grow their account, because the more money that's in their account, the more money we get paid, just in that example that I gave you in the beginning. So, when I explained this to her, she's like, oh, okay, that makes sense, because of how he worked with her. So her next question was, well, besides the way you guys get paid differently, what's the biggest difference? And I was like, okay, good question, actually. So the way that a commission-based advisor works is they're essentially a financial salesperson. They're the person out there that's just trying to either, find new clients because they need to sell new products to them, like mutual funds and annuities, or they're constantly calling you to make transactions because they make money off of those trades that they're making in your account. Versus a fee-only advisor, we're more focused on servicing the clients and managing the money ongoing. Just like I said before, we want to keep you as a client and grow your account. So she asked me then in kind of a funny question of, or does that make you a better financial advisor than the commission-based advisor? And I was like, well, you be the judge of that. I'm not going to really answer that, but I feel like the more you think about it, the more that may answer your own question. So, another question that she asked though was that, well, my advisor, does he have my best interest in mind? And I kind of felt by her asking me that she probably already knew that there might be a little bit of a conflict of interest, which inherently there is, because if he's only calling to make trades on her account, there's naturally a conflict of interest, because he makes more money every time he makes a transaction or sells her a new product. Versus a fee-only advisor, I can make trades every day in my client's account. It doesn't make me any more money, than it would by not doing that. So, inherently there's not a conflict of interest that way. That's why fee-only advisors work as what are called fiduciaries, which just means that we have your best interests in mind ahead of our own or anybody else's. Commission-based advisors can't stake to that because they have that natural conflict of interest because of the way that they get paid. I hope this was helpful. I appreciate you taking the time to check this out. If you have more questions for me about this or any other topics, feel free to shoot me a phone call, throw me a DM out there. DM's direct message for those that you may not know what that is. Or if you'd like to take the investment assessment on my website, there's a link for that above in this post. So feel free to go click on that link and go through the investor assessment on the website there. That'll give you a better idea of exactly how your portfolio is set up, so in areas that you may need to improve on. So again, appreciate you taking the time to check me out.